Welcome back, everybody. As you can see, we have a very special guest today. This is my good friend Anthony. He was a very successful mortgage broker back from 2003 to the 2008 period. As you guys know, everybody compares this housing situation to the 2008 financial crisis, whether you consider it a bubble or all the things that go along with it. So I thought it'd be very interesting to get his input on the current situation and kind of see what he thinks is similar, what's different, and where it's going. And welcome to the show, Anthony. If you could go ahead and introduce yourself, I'd appreciate it.
Great, Ben. Thanks for having me on.
Awesome to have you.
Yes, Ben's correct. I was in the mortgage industry from 2003 to 2008. I've known Ben for nearly 30 years now. Used to tell people over 20, but the years continue to creep past us here, pal.
Yes, they do.
After the collapse in 2008, I vowed I would never be part of the real estate / mortgage industry again, and went into working for a Fortune 500 transportation company and have owned and operated a business as well in that time period. I've owned property since 2005. Ben likes to classify me as a investor of sorts, but I just call myself a homeowner and try to make smart decisions with purchases. Just trying to be like everybody else in America, trying to get that American dream.
Well, and we certainly appreciate you being here with all the insight you bring. And I guess we'll start off with, what do you see as similar, in the run up this time that was as the same as the early 2000s?
As far as similarities go, I'd say the biggest thing that jumps off the paper is the overvaluation of properties. We saw unprecedented growth in property values in the mid 2000s and early 2000s. And only to be outdone by the latest run-up in values that we saw over the last 2 to 3 years here with the pandemic boom. And kind of goes hand in hand with the similarities of how interest rates were low and monetary lending practices were a little looser in the 2000s. And then yet again to be outdone with record interest rate lows this time around. Also, I would say similarly would be the current feel in the air right now. Like, this feels very reminiscent of where we were back in 2006, 2007, heading into 2008, where everything finally did ultimately crash. It's the way interest rates are rising. If you look at all the treasury yields, I know the average Joe, a lot of people don't look at that type of thing. They hear it on the news, but those figures are where we were at levels that we haven't seen since 2006 and 2007. And the interest rates are reflecting that. And at the same time, property values are slowly starting to trickle down, at best case, stagnating.
Yeah, and as we know, property values are stagnating, like you said, if not outright dropping across most parts of the country right now. In regards to the differences, what do you think are the biggest differences you see this time around?
As far as differences go, I would say is the vehicle that brought us through the rise in the 2000s and then the vehicle that brought us to the rise during the pandemic. People talk about subprime during the 2000s, and there's truth in that. And it's really the 100% programs that really got things moving during that time, whether it was an 80-20 split that people were doing conventionally or just subprime non-conforming loans that were 100%. And on top of that, you throw in non-income verifications in, self-employment, stated incomes. So that's really the biggest difference from then till now, where we saw cash buyers creating a huge run-up in the market, or people with large sums of down payment that were waiving contingencies to do anything to get in a home. 100% financing, you didn't see that during this run-up. Those type of people that needed VA or FHA, they were laughed out of the building. They could not compete with what was going on in this environment.
So absolutely, as a boots on the ground agent, yeah, cash was king, and it was very hard to get any financing accepted during those times. A lot of people talk about the subprime crisis, like you said, the no income verification loans, things like that. A lot of investment going on back in 2008 that I don't think gets touched on a lot. A lot of speculative home buying. People may not have been looking to rent them out, but certainly treated them as investments. So I tend to think that was a big part of the 2008 fiasco that nobody talks about. With the cash purchases, what are your thoughts on the investor activity this time?
Yeah, anytime you have big run-ups in real estate, the investor activity kind of follows suit with that. People that generally wouldn't be real estate investor, they all of a sudden feel emboldened to get into the market. You have the people that are going to be home flippers or landlord entrepreneurs are going to try to build a spec home. But we saw that brought to new heights this time around. And, everything out there with HGTV, all the social media platforms, it created a huge push. And this time around, it was, again, like everything else, taken to new heights. We saw the birth of these iBuy companies, hedge fund companies pulling their money together, just buying up, in some cases, the entire HOAs,
Yeah.
Airbnb, the Verbos. And all it did is just, created a FOMO and just ate up the supply of properties that just it didn't do anything for the average person, but create more hardship.
Yeah, so actually, it's with you saying that it's none of the, like you mentioned, none of those things were available. There weren't Airbnbs, there weren't iBuy companies back when you were doing mortgages. So it's almost in your opinion, it and by what you're saying, it seems like it's way worse this time.
Sure. Yes.
Now we know a lot of people jumped in, and in 2008, when I got here to Florida, one thing I noticed, I came in 2015, and I would see all these shell houses, just it's empty, just a roof and concrete, cinder block walls with nothing inside. And I started asking everybody, what is going on here? Why are there so many of these? And it was, you know, because builders had just walked away from them back in the day, and that was in the 2008 2009 timeframe, and they were still sitting there in 2015 when I got here, 7, 8 years later. Do you think we're going to see that again? Do you think we're going to start seeing abandoned construction projects or HOAs half built?
When it comes to that aspect of new construction, I would say the table is set, so to speak, for an end result like that. But first, we're really going to have to go through a period where builders are going through a fire sale type scenario where they have a number in mind that they can sell these projects or properties for and still get out with their shirts on and be able to move on to the next project or take a break and survey the landscape and see the direction that things are going.
Yeah, that's interesting you should say that. That's sort of what we're seeing here now. A lot of builders are doing red tag sales, special sales events, dropping prices by $50,000, offering all kinds of incentives. I think in my area, Southwest Florida, that's sort of what that cascade you mentioned is starting to occur. If you guys see that in your areas, I'd love if you could let me know in the comments. With that being said, what do you think? How do you think new construction fares now that rates are pretty solidly in the eights and could potentially go higher?
Well, anytime you see rates continue to go up, it's always going to put downward pressure on sales, whether it's new construction or existing. And up until this point, new construction has been able to navigate that pretty well with their incentives, offering buy down programs through the mortgage company that they use, offering upgrades, paying closing costs, things of that nature. So up until this point, they've been able to remain pretty competitive. And if they're still able to offer those buy downs, yes, everything's going to incrementally tick up with that as rates go up, but it'll still be a competitive advantage. It'll just yet to be seen how it plays out, really.
Yeah, it's interesting. The whole buy down situation has been sort of their, I don't want to say like their Swiss Army knife solve all kind of thing, but it's been their big push, and it got a lot of people to come in and purchase these new construction houses, even if they were a little slightly over resale. I understand why people would go that route. We've discussed that here before. Now I'm not seeing that that's really moving the needle in regards to the buy down situation. A lot of people will argue that that's basically just an adjustable rate mortgage under a different name. I know you've probably seen quite a few of those back in your day. What are your thoughts when it comes to the 2-1 buy downs and the rate buy downs, and what kind of do you have any concerns with that?
It's certainly a niche that the builders are able to offer right now. And most definitely, this from a sales pitch standpoint, it's 100% identical to what borrowers and buyers were sold back in the 2000s. Take this rate, get in the house, fix any credit needs that you have to take care of, and in 2 or 3 years' time, we'll refi you out, get you into a better rate long term, cheaper payment, and it's really the same sales approach. Yes, this time around, at least you know what your end result's going to be. Say your rate is 7.5% for the 30 years, so that would put you at 5.5% year one, 6.5% year two, ultimately going to your final rate of 7.5%. So at least you know your worst case scenario. It's not really a true adjustable, but anybody going into that type of program, banking on the idea that they're going to be able to refi, not a smart practice.
Yes, and I feel the same way. It's nice to know that there's a settled, agreed upon rate at the end. I guess you are correct. It is a major difference between the adjustable rate mortgages because back then you didn't know what your final rate was going to be. At least here, you know what the end result's going to be, even though that may fluctuate your payment quite a bit.
Yeah, let's take a look at an example just to put it in numbers perspective. If somebody was borrowing $300,000 on one of these 2-1 buy down programs, and 7.5% was the number that I used before, in the first year, their rate would be 5.5%, and their payment would be roughly around $1,700. Year two would go up $200 from that point. Whew. And then year three, it would go at the 7.5% rate, would be right under $2,100. So you're looking at a $400 swing in payment. Now, if you're somebody that's buying a home in today's market and you need to take out a loan, why wouldn't you want to take advantage of this program? If you can save yourself in the first year $400 a month, second year $2,400 a month, you just put $7,200 in your pocket extra on a house that you were going to buy no matter what. Now, if you can be disciplined with that, reapply that money somewhere else, pay off a loan, credit card, or better case scenario, reapply that money back to the principal balance of your loan. Now you paid down $7,200 over the first 2-year period, while you paid off in the ballpark of $7,500 just through the regular amortization schedule. So now you're at nearly $15,000 of pay down in the first 2 years. That may be the little extra that you need to help push you over to be able to do a refi in year three if the values do come down. Now you just established $15,000 of equity in your property within the first 2 years. And if the rates have moved down enough, that may be the little bit to get you there.
Yeah, there's that loan officer I know. I like that. You're absolutely right though. It's if used properly, yeah, you could really take advantage of it, and I understand why buyers do it right now. As we know, most people don't tend to financially operate that way. But that is a great point you make. And when me and others tend to trash the buy downs, they can be used for some good, and they can absolutely have positive effects if you use them in your advised ways.
Yeah, I would recommend anybody to take a look at their 3 to 5 year plan first. If you foresee yourself maybe having to buy a new car, maybe you're going to have a baby in that time period, and at that point, the 3rd year payment, and which is going to be your payment on paper for the remaining 28 years, if that payment's going to be a problem for you, you may want to reevaluate things. But yeah, it could be a tool. And if used properly, it could really put you in a better position once that 3rd year kicks in. I mean, life happens. You can never predict a job loss or an illness or, anything of that nature that would disrupt your household income. But And that's regardless of if you're on a true 30-year fixed or on one of these introductory programs. But I would say take a look at your 3 to 5 year plan and never bank on being able to do a refi.
And to clarify, guys, not financial advice. These are all our personal opinions, but that's an excellent point that you just made there. Um, you cannot bank on a refinance, and so many people are still being sold date the rate, marry the house. It's just, I think it's starting to lose its luster, but like you said, that is the major danger there. And I think if you take advantage of the buy down, like you mentioned, potentially if there is a loss of value, then you may still be able to refinance. But it's so risky for people to just blindly trust that and say, I'm going to absolutely refinance in 2 years.
Yeah, there's so many variables, whether the value is going to be there, whether rates do actually come down far enough in order for you to warrant a refi in the first place. Um,
Yeah, and with that being said, we've we had the Mortgage Bankers Association come out, and the National Association of Realtors just recently predicting rates going to be in the sixes, sometime next year. At the same time, we had Jerome Powell come out just this week and say, the economy's not slowing down. We're not getting the desired results. We may have to raise rates again. Do you think we have a shot at seeing 6% rates by the end of next year?
I think that's bold for them to come out and make a prediction like that. And I kind of chalk that up to some of the marketing ploys that we've seen this entire pandemic era, whether it's never coming down, buy now, get priced out forever. All of these little catchy slogans that try to drive buyers to re-engage if they've left the market. To come out and Zillow does the same thing, making predictions 1 week of 8% year over year price growth forecasts, and then retract 6 weeks later and say that they're downgrading it to only 4%. And I think it's a little irresponsible. I mean, yeah, they're trying to look at, I guess, whatever numbers they have in front of them, but they have a pretty big platform, and to put stuff out there like that, it almost goes hand in hand with what you're talking about with date the rate and marry the house, because this is just fueling the thought that, okay, I can buy it now at 8%, and then next year the Mortgage Brokers Association is forecasting 6%, and I'll be able to get that refi and lock into a lower rate for the rest. So I think it's a little irresponsible and bold. But as far as the whole rate goes, in my personal opinion, I do think that we have seen the last of rate hikes for the foreseeable future. And I think people are very focused on, is it going to be a rate hike? Is it going to be a rate hike? And they need to focus more now on this higher for longer, because where we're at for any lengthy duration at these rates, look what has happened over the course of the last 2 months since we've been consistently up over 7% and now into the 8% range. Worst case scenario here that's shaping up to be is that we enter a period of stagflation, and where everything stays high, both interest rates, both prices, and nothing is moving. And that's the direction that things could potentially start to go.
Yeah, it's interesting you should mention stagflation. It's something I'm trying to figure out myself, is where is the equilibrium between price drops now that interest rates are where they are and wage increases. It may take a very long time. Maybe we don't see massive price drops, and it may take a very long time for the wage increases to creep up. The things that I'm seeing now is, with everything escalating at this speed, with mortgage rates escalating at this speed, people are, as I mentioned, your FHAs, your VAs, even some well-capitalized conventional loans are just kind of rushing into the market to, in anticipation of it getting worse. As you mentioned, you're saying it's probably going to be higher for longer. I agree. At the very least, I would not be surprised if Jay Powell shocks us with another rate hike if the economy runs too hot, like he said. But these people jumping in right now, they're coming in and they're basically I don't know how qualified they are. They're shopping a lot of lenders. I'm seeing a lot of stuff on Facebook from lenders that says basically, if you can't get financed with one guy, don't give up. Let's see what we can do for you. A lot of these lenders are having to become credit specialists to build these people up to a scenario where they can buy over many months. I think you're probably very familiar with that just on how you spoke about the buy downs. It's not something we've seen before. Last year, if you told the lender, "Hey, I need to get my credit together. Hey, I need to work on things," they'd be like, "I don't got time for that. I don't, yeah, I ain't got time for any of that." Um, and I'm seeing, people that generally aren't qualified really, really make a rush to get into purchasing. Again, like I've mentioned, I know the rental rates have a huge impact on that. Even if you can find an affordable rental, people don't want to get stiffed by their landlord again. But to me, this is creating risky buyers that I think in 2 years are going to find themselves in a bad situation, especially if they're fiscally irresponsible and they get a rate buy down and they don't take advantage of the opportunity or apply it to the mechanisms that you had mentioned previously. You know, in the last downturn when you were in the industry, were you seeing, like a similar scenario? Were you seeing people just try to claw to get their hands on anything and get financed in any way possible, even though prices were declining and it was getting much more harder to do that?
For sure. I tell everybody during that 2006, 2007 time period, there was no shortage of business. There was
Mm.
probably as much or more than the years leading up to it. And a lot of that was because of desperation. And I would say a lot of it was refi business. And it was the biggest problem is you were seeing people that were either bought the home or refinanced 2 to 3 years prior to 2006, 2007, and they were already in a 5 or 6% interest rate, or some cases 4 if they took a 15-year loan out, and now they needed to refi because they racked up credit card debt, fell behind, whatever the case is, and now rates started to move in 2006, 2007. Values were coming down, and the runway wasn't there. There was no benefit to borrower to show on paper in order to pull it off. And you talk about some of the desperation on the borrower side of it, but also the desperation on the professional side of it, the real estate agents, the mortgage industry people. Everybody is commission based in that line of work, and they're only as good as their last sale as far as a paycheck goes. And if the deals weren't closing, that's when the urgency was setting in for them as well. And it was funny. Everybody kind of like knows if you want to get a good deal on a car, you go to the car dealership at the end of the month. And that's sometimes when you can negotiate the best deal because they're trying to make their month's end numbers. And the same thing could be sort of said for the real estate industry. Deals that were not qualifying for a loan in the beginning of the month, all of a sudden, everybody's trying to make month's end numbers. Now all of a sudden, they're able to get an exception.
Mm.
Now, maybe their debt to income ratio numbers were close. They were over, but they were close. Now all of a sudden, it flies. Maybe they needed the 95% LTV program, but they only qualify for 90. But now at the end of the month, they're willing to give them the 95%. So,
Wow.
it was, and that type of thing that was mainly in the subprime, and which would be a risky category to begin with. So then you top that off where you have a borrower that's in a risky credit category, and now they're not even meeting the minimum guideline expectations for that loan. So that's when things really started to get dangerous, I would say.
That's very interesting because that's, as we spoke about, it's kind of what I'm seeing here. Yeah, and as far as the industry, I've spoken ad nauseum on that. It's like being at a funeral talking to people in the industry lately. They're very nervous. People are getting out of the industry left and right. Nobody really saved up what I thought they should have. I mean, when the good times are good, you gotta sock things away. A lot of people don't appear to have done that. Something I want to touch on that you mentioned was the refi. Uh, it's very interesting when I go to sell some houses now. Um, I guess that would be a similarity to what you saw back then. When I go to sell a house and I try to do like a net sheet and I look up the tax record and the person's got 5 refinances since 2016, like one a year almost, 5 refinances in a row. Um, there's not a lot of meat left on the bone. I think that's going to put a lot of people in trouble as well. But like you mentioned, the refinance and the HELOCs, they've kind of just been used as an additional credit card. I think I told you a while back, my mortgage guy was, it's so funny you say that. That's exactly what my mortgage guy tells me. He goes, I'm staying pretty busy with refinances right now, man. And that would surprise a lot of people. But like you said, it's the last piece of runway, to kind of pay off the credit cards and pay off the auto loans, which are at 20, credit cards are 20 something percent. So people ask me, why would someone refinance their house right now or do a cash out at 8? Well, it's better than 20%. So I think, hearing that from you, it kind of sounds like the pattern is almost right in line, because now we're out of runway on the equity. There's no more equity to pull if you've pulled it recently or several times. So it's going to be interesting to see how that impacts all aspects of the economy going forward.
Yeah, it's really a chessboard right now, and like you said, all the pieces are laid out. Whether it's the new construction portion of it, or the same scenario where the people who bought 2-3 years ago have the golden handcuffs. They have 3-4% interest rates, some cases 2%, and now credit card debt is mounting. Are they gonna cash that 2%, 3%, 4% rate in to go to 8% to live the fight another day? If the equity is there in your house. So a lot of it is, so to speak, the table is set.
Yeah, as you mentioned, it does look like the board is set. The dominoes are about to fall in some manner. Based on your experience, do you think we'll see a full blown 2008 meltdown? I know you mentioned stagflation. So is that more the way you see things going? Which scenario do you see more likely to play out in your opinion?
As we talked about earlier, most of the country is in the midst of a correction as we speak. And the severity and the degree of that correction is going to be very geographically driven. Every local market is unique in and of itself. And ultimately, if that turns into a collapse of 2008, I think is going to be very dependent on if we see unemployment raised to the levels that we saw in 2008. Without people being in distress, having to dump these houses, I don't see us getting there. Homeowners currently, we talked about the overvaluation of property, and even with a correction, there's still significantly more equity in these homes than where we were just 5 years ago. And that's going to give many homeowners the leeway to make financial maneuvers, in an emergency situation.
Yeah, assuming they haven't refinanced 5 times. That's the big variable. Um, yeah, I think I agree with you. Without unemployment really going to the moon, to coin another phrase of this cycle, it's going to be tough. So I am, and every market's different. As I've mentioned down here, we're getting hit what I would consider pretty severely. When I see 10% price declines year over year, that's big for me. Doesn't match other areas of the country. So, when there's, like you said, when there's headlines with Zillow posting 5% growth year over year, we're back to all-time highs. Like you mentioned, it's very market specific. You are up in the Carolinas area, and I often use your market specifically as an example, because while we were basically scrambling to get offers, someone to make an offer on these overpriced houses down here in Charlotte County, you guys were seeing bidding wars over the summer. Why I try to explain that to people is you could just get such a nicer house, such a better house, bigger land up in that area for an affordable price. So people were flocking to the affordability. I think you had mentioned, there's a lot of California, Florida, New York plates in the area. What's your market like right now? I mean, since you're coming out of your typical selling season, we're in October. Are you still seeing bidding wars? Are things still going fast up there?
Even our market has slowed down of late with the way that interest rates have gone. Um, the, the spring summer sales market, which is generally the busiest time, was very busy. We did see homes going for over ask. We did see highest and best on properties, and everything is location driven. We're talking about turnkey homes that were in good school districts, close proximity to shopping. So, these were desirable homes that I'm talking about. But as a whole, the market was very strong for the spring summer selling season. Um, Inventory still remains very tight. I would say it's probably worse now than what it was during the spring and summer months. But there's definitely a change in the air. You can definitely feel that there's a shift going on. How that continues to play out going forward. Like I said, these turnkey homes in the 250 to 300 price range, which seems really to be the sweet spot, so to speak, for first-time home buyers and median income families. Those are the homes that are drawing the most attention and continue to command either full price offers or over ask. And unless, as you mentioned too, income comes up, that's going to continue to be the target area for these people.
Yeah, it's interesting you mentioned that. That's pretty much what I said in my previous video here too. Uh, Anything under 300,000 is sort of our sweet spot. I actually think it's going to intensify with rates where they are. I have a listing I'm trying to get coming up here that's going to be right under 300,000. And we've had discussions with the seller. Is that the right price point? I think it is. I think everyone, because of rates, who was in the 400,000 price range 6 months ago, or even the 500,000 price range a year ago, is kind of coming down in the low threes. I think that's going to stay a very competitive market. That seems to be the only price point that we have that is moving relatively quickly right now. It's anything over 350 to 4 is really languishing. Are you seeing higher priced homes sit by you as well?
Yeah, sure. They are sitting a little while longer, but again, it gets back to the inventory. Even though that they are sitting a little longer, just because there's not that big of a buyer pool for that price range, there's still not many of those homes available, even in that price range. So if there was 50 of them, then I would say there'd be a little more red flags for cause for concerns. But it's not like there's a ton of them. There's not that many.
Yeah. Yeah, that's the interesting part, and that's the big contrast here too that I'm trying to get through to everybody. We have so much inventory, and I mean, God, we have hundreds of houses over 400, 500 grand, which for this county is very, it's not traditionally how it goes. I mean, we may have 7 months of inventory here soon, and this is supposed to be our slow time as well, and we are piling listings on daily right now. So very different markets here. Yours is still tight, and ours is going heavily in the other direction. And I'm sure around the country, like you mentioned, that's going to be the big difference area to area, and we'll see how it shakes out, in the
Yeah,
long run.
I'll add to that too, that I will also see that the time to close is much different, which shows that there's more financing going on right now than what there was in months previous. Previously, over the summer, you were seeing houses from contract to close anywhere from 2 to 3 weeks. And it could have been a combination of all cash or just, really fast financing as well. But now we're seeing homes that go under contract, and they are taking sometimes upwards of 2 months from contract date to close. Whether that's a combination of financing issues or issues with the home being remedied that came up during inspections. But regardless of what the cause is, they are staying on. They are taking longer to close.
Yeah, yeah, and it's interesting to hear 60 days, and most people that have been in the industry only 2 or 3 years will think that that's a long time, but it's pretty has been pretty standard. Um, Even mentioning maybe repairs need to be done is something that was out of the realm just a couple of months ago in some places.
One other thing that we did see was flipper activity very high over the summer.
That
And
is interesting.
yeah, and they were extremely fast. We were seeing 60-day turnarounds on some of these homes where the investor was buying them, renovating them, reselling them within 60 days over ask.
Wow. Yeah, that's almost we had a little bit of that here. People were picking up the hurricane houses, but our investor activity has pretty much ground to a halt at this point. It's interesting to see that they, like you said, from the get-go, the cash buyers have been the driver and the investors, and that's a great example right there. We've seen them leave Florida, and now you're picking them up in the Carolinas because they still have those price points to be able to do that. Yeah, so just very interesting times all around the country. Things are different. Listen, Ant, we're gonna wrap it up on that note. I really appreciate you coming on here and sharing all this today, and just shooting it with you has been a blast.
Thanks for having me, Ben.
Absolutely. We'll have to get you back sometime. Thank you guys for tuning in. Let us know what you think in the comments below. If you have any questions or any other things you'd like to see us tackle, give me a like, share, subscribe if you like this video, and I'll see you next time.